Has the world's most powerful economy fallen into its own trap? Today, the United States is facing an economic war, not just in the realm of dollar bonds or the stock market, but one that strikes at the heart of its identity, power, and future. After a sweeping victory in the 2024 elections, Donald Trump has returned to the White House with a clear mission: to make America number one again, no matter the cost. But the ripple effects of his decisions extend far beyond U.S. borders. They're shaking the foundations of the global economy. Even Treasury Secretary Janet Yellen has admitted that America's credibility is weakening. Major economies like China, Japan, and India are now reluctant to purchase U.S. debt. In just 1 week, U.S. bond yields have surged from 4% to over 4.4%, an extraordinary spike that's dealt a serious blow to demand for U.S. treasuries. Traditionally, in times of crisis, global investors saw U.S. bonds as a safe haven. But now, they're selling instead of buying. What's more troubling is the underlying irony. The original strategy behind this crisis was to lower bond yields by triggering a recession. Instead, the opposite is happening, and it's pushing the U.S. deeper into uncharted territory. The real crisis now is that the U.S. must refinance trillions of dollars in debt in the coming months, and at significantly higher interest rates. In 2025 alone, America will need to reissue over $9 trillion in debt. But if Treasury yields keep rising at this pace, the government faces a difficult choice: either issue long-term bonds, which carry high risk, or flood the market with short-term Treasury bills. Both options come with serious consequences. The latter, in particular, could erode investor confidence even further and put the entire financial system at risk. Trump's aggressive tariff policies, aimed at curbing Chinese and foreign influence, have also weakened global demand for the U.S. dollar. A 10% decline in global trade with the U.S. translates directly into a similar drop in dollar demand. As a result, the U.S. dollar index has fallen below the critical 100 mark, a psychological barrier. Its breach has prompted more investors to start betting against the dollar. Now consider this: about 15% of U.S. consumption relies on imports. A weaker dollar makes those imports more expensive. But since America still lacks a strong domestic manufacturing base, the country doesn't benefit from a weaker currency the way export-heavy economies might. Instead, the U.S. gets hit with higher prices and reduced purchasing power. Inflation rises while consumer spending stalls. In short, both inflation and recession are now knocking at the door simultaneously. Following Trump's announcement of a 90-day pause in the trade war, many believed the crisis was easing. But a recent study by Yale University reveals a much harsher reality. The impact of this temporary relief is minimal at best. In fact, the average U.S. tariff rate has jumped from 3% to 18%, and if consumers are unable to find affordable alternatives, this could rise to as high as 25%. According to Yale's report, the consequences are already beginning to show. U.S. GDP could shrink by 1% this year. Unemployment may rise by 0.6%, and approximately 754,000 jobs could be lost. More importantly, these aren't just short-term effects. The study warns that the economic damage could stretch all the way to 2035, with the GDP expected to remain 0.6% lower than it would have been without the trade war. This makes one thing clear: the crisis isn't just immediate, it's long-term, and its consequences may run deeper than many initially feared. When it comes to the ongoing trade war between the U.S. and China, neither side is willing to back down. Trump has hiked tariffs by over 140%, and China has responded in kind, raising tariffs on U.S. goods by 125%. Now, China is making its stance clear. If the U.S. wants to cut itself off from the Chinese market, so be it. This signals not the end of the trade war, but its escalation into something far more intense. But America's challenge now goes beyond China or tariff battles. Its entire financial credibility is being questioned. That's why foreign investment in the U.S. is starting to dry up at an alarming rate. Investors who once considered the U.S. the safest haven in the world are pulling their money out. Trillions of dollars had been parked in U.S. bonds, stocks, and corporate debt. But now prices across all three are falling. The stock market has dropped by nearly 10%, the dollar index is down 5%, and U.S. government bond prices have fallen roughly 8%. These are clear warning signs. Global investors are beginning to lose confidence in the U.S. economy. And if this trend continues, even the U.S. Treasury market, the backbone of America's financial system, could be in jeopardy. Just look at India. In September 2024, it held about $247 billion in U.S. Treasury bonds. By January 2025, that figure had dropped to $225 billion. $22 billion pulled out in just a few months. A similar pattern is emerging in Brazil, where holdings dropped from $234 billion to $199 billion. These are not minor adjustments. They reflect a fundamental shift in how these nations view America's financial stability. But perhaps the most striking case is Saudi Arabia. As one of the world's most influential oil economies and a key player in the global energy market, Saudi Arabia's financial moves carry weight, and even it is now rethinking its exposure to U.S. debt, a signal that the cracks in America's economic foundation are being noticed at the highest levels. For decades, the economic and political partnership between the United States and Saudi Arabia served as the bedrock of the petrodollar system. Saudi Arabia was not only a key ally, but also a major investor in U.S. Treasury bonds, playing a pivotal role in supporting the strength of the U.S. dollar and the financial stability of the American economy. But that picture is changing rapidly. In recent months, Saudi Arabia has quietly begun to withdraw its investments from U.S. Treasuries. Where it once held around $139 billion in U.S. debt, that figure has now dropped to just $126 billion. This isn't just an economic decision, it's a signal. A signal that even America's most loyal financial partners are beginning to lose confidence in the long-term health of the U.S. economy. And Saudi Arabia isn't alone. Major global economies like Japan, China, India, and Brazil are also strategically reducing their exposure to U.S. bonds. These nations have long been considered pillars of the American financial system, the very foundation that has upheld the dollar's value and America's influence in global markets. But when that foundation begins to crack, the effects reach far beyond Wall Street. A weakening dollar, rising borrowing costs, and disrupted global trade are just some of the consequences that can follow. And it's becoming clear, the situation is steadily deteriorating. The promises Trump made at the onset of the trade war, to make America stronger, wealthier, and more independent, are now unraveling. Bond yields have soared, major economies are pushing back, and trust in U.S. financial leadership is eroding. The big question now is, can this trend be reversed, or is the U.S. headed for an even deeper economic crisis? With a mountain of debt looming and trust dwindling, the pressure is mounting. Will Trump adapt his policies to stabilize the economy, or double down and risk an even greater fallout? If you found this information valuable, don't forget to like and subscribe to stay updated with all our upcoming content. Thank you for your support.